Stock options. Gotta love it. This is how people make their money. I mean, there's a lot of ways to make money. But when people make money, the IRS wants a little chunk of change from that as well. And as such, we'll talk about how you're going to calculate what you owe to the government because of your stock options. This is you receiving stock instead of cash, working for a company. Let's run through it. First off, we're going to run through definitions, different types of stock options, see the repercussions of, again, just these various different types. First, we've got non-qualified stock options. These are a type of employee stock option that generally do not meet the requirements for special tax treatment. Very sad, I know. They're taxed when granted if they have a readily ascertainable value. That's like a key phrase I would definitely make note of. If you see readily ascertainable value in a question, that's, again, something you'd want to see. And if you don't have that, that will have implications and repercussions. We'll see through examples what that means. However, they usually do not have a readily ascertainable value and are taxed when exercised. It's hard to say what your stock options are going to be worth in 10 years, so that's why they may not have one. However, if a valuator comes in and kind of values the stock options, that's where that would come from. Employee taxation depends on whether the option has a readily ascertainable value or not. Employer taxation allows a deduction of the fair market value as a business expense in the year that the employee recognizes the income. So from the perspective of the company as well as the individual, what are the different tax treatments? There we go. Qualified stock options. These are options that meet specific requirements to receive favorable tax treatment, and boy, do we love favorable tax treatment. They include these two types of stock options that we'll dive into further. First, we've got incentive stock options. These must meet several requirements, such as shareholder approval, granting within 10 years, and the exercise price not being less than the fair market value. The employee must hold the stock for at least 2 years after exercise and remain an employee until 3 months before the option is exercised. All these rules preventing you from kind of just getting the heck out of there. It's incentivizing you to work harder for the company. There's no taxation for employees when granted or exercised, and gains/losses on the sale of stock are capital. Employers receive no deduction for ISOs. Again, just from each perspective, what are they recognizing? What are they responsible for? And then we've got ESPPs. These employee stock purchase plans have various requirements, such as written plans approved by shareholders, inclusion of all full-time employees. So if you're excluding a certain department, saying, oh, the accounting department cannot get into this program, but the operations department can. So that would not make it a fully eligible employee stock purchase plan. And we've got exercise price limitations. They also require stock to be held for at least 2 years after the grant date, and for the employee to remain employed until 3 months before exercise. Employees are not taxed when granted or exercised, and gains or losses on the sale of the stock are capital, except in cases where the exercise price is less than the fair market value. And for these, employers receive no deduction here. So all of these different stock options, these are existing to kind of get you invested in the company. You may have experienced this yourself working for a company. You may not have, but if you have, it does help to think about that. There's actually plenty of topics throughout all the exams, actually, where sometimes the textbook way of doing it, which is what we need to know, is different than how it works in real life. Boy, does that really happen in audit. So having real life experience does hurt you in some cases. And I make sure to call that out because that's definitely something that confuses a lot of people. And I understand the aggravation of having worked in those fields. And that's not how that works at all. But here, if you've ever experienced any of these plans, think about it like that. All right. Well, first off, we just kind of dealt with all the different types of stock option plans. But overall, just in general, let's talk about equity-based compensation. This is encompassing everything we just saw on our previous slides. And this is going to include our stock options and restricted stock. These are methods used by employers to motivate employees and encourage them to take ownership in the company. This could be something like working for a company listed on the New York Stock Exchange, and they have the ability for you to buy stock at a cheaper rate. And then obviously you can go sell the stock on the open market after the vesting period. You've also got private companies. I know, for example, there's private companies such as Wawa. I don't know if any of you are fans out there, but they've got an opportunity for you to buy stock in a private company. Plenty of private companies do this. That's just the first one that came to mind. So this, again, is a way for the employers, for the managers, for the owners to say, hey, we want everyone to kind of play a role to take stock in the entity and to get rewarded as the entity does better. Now, when employees hold equity, their compensation is tied to the employer's stock price, aligning their interests with the company's performance. However, this form of compensation also comes with risks and rewards. depending on the fluctuations in price. If all of a sudden Wawa tanks, no one goes to Wawa anymore, the stock for Wawa is going to drop, and anyone holding it is going to suffer. And who values that? Not really too important for the exam. But yeah, even though it's not on the New York Stock Exchange and you can constantly look up the price, there are internal systems and valuations that will value the stock that you hold. I personally have never had a company give me stock. It's very sad. I know. Maybe one day. Maybe one day they'll value me. Not that I've worked for, it's always been accounting firms. And accounting firms, as we know, do not have stock. They are partnerships. Now, the value of equity based compensation depends on the performance of the employer's stock. If the stock price increases after granting options and restricted stock, employees can benefit significantly. However, if the stock price does not rise, the restricted stock's value will be limited and stock options may expire worthless. There is an expiration date. You do have to exercise them by a certain date. Employers must issue new shares to satisfy option exercises and stock grants, increasing the total number of shares outstanding. This increase leads to earnings per share dilution, which can negatively affect existing shareholders. I mean, this whole topic overall is super big on the financial exam. Got a lot of lessons on that. And if you want to understand this from the financial perspective, feel free to jump into that exam and go for it. I mean, you've got access to that as well. So, but I mean, obviously we're focused on the tax exam. I'm always thinking about all the exams. That's my job. All right. Well, stock options, they give employees the right to buy employer stock at a specified exercise or strike price. So I'm just going to write out some numbers, kind of demonstrate how these work if you're not familiar. Let's say you receive stock options. The company is trying to reward everyone. They're saying you can buy our stock for $50 a share. And let's say you receive 5 options, and an option entitles you to buy 10 shares. So that's how these could work. An option, think of it like a piece of paper. It's an asset. It's something beneficial to you. So you have 5 options that entitle you to buy 10 shares each. So you're entitled to buy 50 shares at the price of $50. Now, let's say on the grant date, the stock on the open market is only worth $20. So it would be stupid to exercise this because I could just go on the open market and buy stock for $20, whether I'm working for IBM, Google, any sort of company like that. I would not exercise this. However, let's say that 5 years later and before the stock options expire, the price goes from, say, $20 to $70. Awesome. That's pretty great. Well, first off, congratulations to the company. Everything's going well. So now I can exercise these stock options. I can say I'll buy all of these shares. So I get to buy 50 shares for $50 and immediately sell them on the open market for $70. So I just made a profit of $20 per share. Sounds pretty good. Obviously, you need the stock to go up. You need the company to not go bankrupt. And that's how that all works. Now, employees can exercise these options between the vesting date. So vesting, similar to a 401k, you have to work at the company for a certain period of time. Might be, let's say, a 5-year vesting period. It depends on the question or the situation in real life. So this is when they gain the right to buy the stock options and the expiration date. If the share price does not surpass the exercise price within this time, employees will not exercise their options and they will expire without providing any benefit. So you could go from possibly hitting it rich to nothing at all, sorry to say. Stock options typically have a 10-year lifespan. This don't take that to heart. I mean, for the exam, it can say whatever it wants, but sometimes I like to interject some real life items into the exam prep here. The future value of stock option awards depend on factors such as the exercise price, the company's future share price, the option exercise date, and the timing of selling the shares obtained from exercising the option. When an employee exercises stock options and purchases shares, their net worth increases by the difference between the exercise price and the market value of the acquired shares on the exercise date. This difference is known as the bargain element. Nice introduction to all this equity-based compensation, stock options, all that good stuff. Important to understand for the exam because obviously this is going to get taxed. You don't think the government's going to let you just get a benefit and not get taxed on it, do you? All right, as we saw, the classifications for these employee stock options classified as either non-qualified or incentive for tax purposes. They differ in how this bargain element is taxed. The bargain element essentially just being your gain, as we talked about on the prior slide, with NQOs being more favorable for employers and ISOs being more advantageous for employees. Let's not get into why a company would choose one or the other. We just need to know how to understand the taxation ramifications for all of these. Now, for both, there are no tax consequences on the grant and vesting dates because nothing really happened. It's you gave someone a contract, and what are the chances they'll exercise it? We don't know. It might expire. They might just never exercise it. So this is not taxable. Nothing's going on here. Also, I mean, for financial purposes, journal entries, I'm not going to get into that. You'll get to that on your other exam. When employees exercise these NQOs, they report ordinary income equal to the total bargain element, which again is the difference between the fair market value and the total amount you paid for the shares, regardless of whether they hold or sell the shares immediately. So that's interesting because you're paying tax on that. But what happens if you exercise it and the shares dip? Well, that sucks. That's not fun. The basis for NQOs is the fair market value on the exercise date, including the exercise price and the recognized ordinary income from the bargain element. On the other hand, when employees exercise these incentive ones, they don't report any income for regular tax purposes as long as they don't immediately sell their shares. So we see how this is more preferential for employees. The basis for shares acquired with ISOs is the exercise price, and the holding period for both of these does start on the exercise date. Understanding long-term versus short-term. Now, employees who purchase stock with NQOs and retain it are in the same tax position as any other investor. Their basis in the stock is the fair market value on the exercise date, and any future appreciation or depreciation is treated as either short-term or long-term capital gains or losses based on the holding period, which starts on the exercise date. So that's a great way to think about it. You're just in the same position as any other investor who just buys in. Now, to avoid overweighting their portfolios with a single stock, employees often perform a cashless exercise by immediately selling all or a significant portion of the shares acquired on the exercise date. Not that that's important. Again, just kind of tying it into the real world as well. Now, for employees who acquire shares through our ISOs, there's an additional tax benefit. And as we said, this is better for the employees. If they hold the shares for at least 2 years after the grant date and 1 year after the exercise date, they will not be taxed until they sell the stock. Again, it's great, but it's an incentive. Government wants you to have more stability in the market. Prices of stocks always going up. When they sell, the difference between the sales proceeds and the tax base, which is the exercise price, is treated as a long-term capital gain in the year of disposition. Therefore, employees generally prefer ISOs over NQOs, as we've seen. Hopefully that makes sense by now. But I think great way to go about it. Here's a nice little way to kind of remember, understand everything. This highlights the general tax treatment of our NQOs and ISOs and restricted stock from both the employee and the employer perspectives. So just take a look here. I think it's a great little memorization guide. All right, we mentioned that readily ascertainable value, and it's back. It's back and better than ever. Now, non-qualified stock options, they're a type of employee compensation in which an employee is granted the right to purchase company shares at a specified price, known as the exercise price. NSOs differ from qualified options in that they do not receive that sweet preferential tax treatment as we saw. Now, when determining the tax implications, this concept of readily ascertainable value, God, just love the phrases. Understanding the important key phrases here is so important for any topic on the exam. Readily ascertainable value refers to whether the value of the stock option can be easily determined at the time of grant. Again, just think about it. If someone from a valuation team comes in and values them, that's kind of what we're talking about here. Now, if the option has one of these, I'm not going to say this phrase time and time again, it's going to be taxed at that time. Because it's like, hey, here's the value you're getting. Okay. Just like many topics throughout the exam, if you can identify an amount for it, you can get taxed on it. Same with financial accounting. If you can identify an amount, you should probably accrue for it. However, many NSOs do not have this value, as we talked about, so they're generally taxed when they're exercised. An option has this value if it's traded on an established market, or if all of the conditions are met. If the option is transferable, the option is exercised immediately in full when granted, and there are no conditions or restrictions that would significantly affect the value, and the fair value of the option privilege is readily ascertainable. Generally, on the exam, you'll just be told if it's readily ascertainable or not, and you can go from there. But here's extra information if that does come up. So, for example, suppose we have an employee receiving a non-qualified stock option. It's got an exercise price of $50 per share. If the option meets the conditions for having a readily ascertainable value, the employee recognizes ordinary income in the year the option is granted. If the option costs the employee $10, the ordinary income would be the value of the option minus the cost, which is $10. When the employee exercises the option, there's no additional taxation. We're not trying to get hit with double taxation here. I mean, no one is, but that's how these rules work. Specifically as well, the basis of the stock will be the exercise price plus any amount previously taxed on the date of the grant. The holding period for determining this begins on the exercise date. We saw that before as well. Holding period, very important for short term versus long term. Now, if the employee allows the options to lapse, they can recognize a capital loss based on the value of the options that were previously taxed. Also, it makes sense if you were taxed on something, it just goes to zero, you don't have any value. You want to be able to deduct the loss that you saw on that. On the other hand, if the option does not have a readily ascertainable value, taxation occurs on the exercise date. The employee then recognizes ordinary income equal to that bargain element, which, again, drilling down what the bargain element is, essentially just your gain. It's the difference between the fair market value of the stock and the exercise price. The basis of the stock is the fair market value of the stock when the option was exercised, and the holding period begins on the exercise date. Now, if the options lapse without being exercised, the employee can deduct a capital loss equal to the price they paid for the options, if any. Nothing too wild, just more rules. I mean, a lot of this stuff, it's just a lot more rules. It just takes time. It takes practice, but you'll get it, just one after another. Diving a little bit more with our non-qualified stock options. Well, employer taxation, we talked about employee. This is relatively straightforward. When an employee exercises a non-qualified stock option, the employer can generally claim a tax deduction equal to the amount of ordinary income recognized by the employee as a result of the option exercise. The employer's tax deduction occurs in the same year the employee recognizes the ordinary income. The deduction is typically treated as a compensation expense for the employer, and also something you'd see on the financial exam with journal entries. For example, let's assume that company XYZ grants an employee a non-qualified stock option to purchase 1,000 shares at an exercise price of $10 per share. After a certain period, the employee decides to exercise the option when the fair market value of the shares has increased to $25 per share. Now let's talk about the bargain element. That is the difference between the fair market value and exercise price. And if you're not sick of me saying that by now, oh, you will be. I think we're wrapping up pretty soon. This is going to be $15 per share. That's 25 minus 10. Now, since the employee exercises options for 1,000 shares, the total bargain element amounts to $15,000. And you could see this as one option entitles you to 10 shares, or maybe it's just one option to one share. Just keep in mind that process. Again, that's also something you'll see on stock options when it comes to financial. I know I'm talking about other exams. I'm cheating on this exam. I'm talking about others. Well, we should be focused on this one. In this case, the employee recognizes $15,000 as ordinary income, and consequently, company XYZ can claim a tax deduction of $15,000 in the same year. The employee exercises the option, as this is the amount of income recognized by the employee. It's kind of as if they just paid them in cash as a salary or a bonus. For the employer, this is treated as $15,000 compensation expense. It's important to note that this employer tax deduction is subject to certain requirements and restrictions, such as compliance with tax laws and regulations, yada yada, not too important there. However, this next line, additionally, the employer must properly report the income and the corresponding tax withholding to the IRS and the employee on Form W-2. So there we go. That is important because we could see W-2 in the form of an exhibit on a sim. And now you know, watch out for that. All this stuff could pop up where you least expect it. Understanding how the exhibits work, understanding how sims are going to absolutely mess with your head will help you. Takes practice, but you can do it. And let's just run through a little bit more on qualified stock options, just key points here. These include incentive stock options and employee stock purchase plans. They provide employees with the opportunity to acquire company shares at a discounted price, often as a part of their compensation package. For many reasons, there's a certain cap you generally pay someone for a salary. You're not going to pay a CEO $1 million. Well, first off, there's one reason we should know based on this exam. You cannot deduct after a certain amount for your highest paid employees. That's something that you'll see on this exam as well that we cover. So there's a reason they get other forms of compensation, such as stock options. Also, this stock options can incentivize your CEO, CFO, key employees to really do a good job because they want the stock price to go up, obviously. Now, these options are going to receive preferential tax treatment compared to our NSOs. Now, incentive stock options, they're typically granted to key employees and provide them with the right to purchase company stock at a discounted price. They must be granted under a plan approved by shareholders, which outlines the total number of shares that may be issued and the eligible recipients. Shareholders don't want themselves to get diluted and the value of their earnings per share to get diluted. They must be granted and exercised within specific timeframes. Generally, that's 10 years from the plan's adoption or approval and 10 years from the grant date. The exercise price must not be less than the fair market value because that'd be kind of like cheating, saying right now you can buy the shares for $10 and sell them on the open market for $20. So I think that's a pretty important rule as well. Employees owning more than 10% of the combined voting power in the corporation, parent, or subsidiary are generally ineligible for ISOs. You got a little bit too much control at that point. To receive preferential tax treatment, the employee must hold the stock for at least 2 years after the grant date and 1 year after the exercise date. Additionally, the employee must remain with the company up until 3 months or 1 year in the case of permanent and total disability before exercising the option. So just the ones I talked about more important here, but overall, nothing too wild. And then lastly, employee stock purchase plans. These allow employees to purchase company stock, often through payroll deductions at a discounted price, and they can offer tax advantages when the plan meets our IRS requirements, such as offering the plan to all eligible employees and setting a maximum purchase limit. So, really, the key point for our ESPPs is this point for our incentive stock options, really just in general, getting a good idea of all those items there. All right, we're beating home a couple points to just make sure you know for qualified stock options. Generally, no taxation of the option as compensation when the ISO or ESPP is granted or exercised. The basis of the stock is the exercise price plus any amount paid for the option, if there is any. Any gain or loss on a subsequent sale of the stock is treated as capital, providing the holding period requirements are met. If the requirements are not met, any gain is treated as ordinary income up to the amount by which the stock's fair market value on the exercise date exceeds the option price. And then number 4, if the options lapse, there is generally no deduction available as the option was not taxed initially. However, a loss may be recognized if an amount was paid for the option itself. And lastly here, employees may exercise up to $100,000 of ISOs in a year. Any amount exercised above this limit will be treated as a non-qualified option. All right, just a couple other I'll call them fun facts, but these fun facts will earn you points on the exam. All right, let's run through an example here of incentive stock options. Well, Green Tech Corp granted an ISO for 300 shares to Jennifer, an employee, on April 10th, year 1. The option price and the fair market value on the date of grant was $100. Jennifer exercised the option on July 5th, year 3, when the fair market value was $130 per share. She sold the stock on November 12th, year 4 for $200 per share. Now, how much gross income here would Jennifer recognize in year 4? Paying extra attention to the dates. That could be a great way for them to trip you up on the exam. Let's not get messed up by those. Well, Jennifer recognized a gross income of $30,000 in year 4. How do we get that? Well, she purchased the shares for $100 per share, a total cost of $30. She then later sold those shares for $200 per share, yielding total proceeds of $60. The gain is pretty simple then there. It's just 60 minus 30. This gain, which represents an increase in the value of the shares from the time of purchase to sale, is recognized in the year of sale, which makes sense. And again, these are the ones that are more preferential for employees. Given the holding period requirements for incentive stock options have been met, this gain will typically be subject to long-term capital gains tax. And I think we're good to go on that one. Another example down. Next up, employer taxation of qualified stock options. Well, we've got our 2 types again. This is different from non-qualified stock options. Generally, employers do not receive a tax deduction when employees exercise qualified stock options. For ISOs, when an employee exercises an ISO and meets the holding period requirements, the employer does not receive a tax deduction. So sorry. Very sad. However, if the holding period requirements are not met and the employee recognizes ordinary income as a result of a qualifying disposition, the employer can claim a tax deduction equal to the amount of ordinary income recognized by the employee. And then for our ESPPs, when an employee exercises one of these and meets the holding period requirements, the employer does not receive a tax deduction for the transaction. If the employee sells the shares before meeting the holding period requirements, the employer can claim a tax deduction equal to the ordinary income recognized by the employee due to the sale. Example here, let's assume that XYZ company grants an employee an ISO to purchase 1,000 shares at an exercise price of $10 per share. After a certain period, the employee decides to exercise the option when the fair market value of the shares has increased to $25 per share. Now, the bargain element, we've seen this time and time again. This is the difference between the fair market value and the exercise price. This here is going to be $15 per share. That's the 25 minus the 10. Since the employee exercises options for 1,000 shares, the total bargain element amounts to $15,000. That's 1,000 shares times 15. In this case, if the employee meets the holding period requirements, which is holding the shares for at least 2 years after the grant date and 1 year after the exercise date, the employer, company XYZ, will not receive a tax deduction related to the exercise of the ISO. However, if the employee doesn't do their part, doesn't meet the requirements, they fail to meet the holding period requirements and sell the shares, resulting in a disqualifying disposition, the employee will recognize ordinary income based on the bargain element. In this case, company XYZ will be able to claim essentially compensation expense as a tax deduction. All right, pretty crystal clear, running through them, having a good time. Another example here of employer taxation of stock options. We've got Sophia, an employee of Solar Tech, earned a salary of $80,000 in year 3. In addition, the following 2 transactions between Sophia and Solar Tech occurred in year 3. Sophia got a bonus of 200 shares of publicly traded stock worth $20,000 with a basis to Solar Tech of $12,000, and Sophia purchased 500 shares of unrestricted Solar Tech stock pursuant to a non-qualifying stock option plan for $15 per share when the stock was valued at $35 per share. Lots of different transactions here. It's great to see. What amount of compensation should Solar Tech report on Sophia's Form W-2 for year 3? Great question. We got to be familiar with those forms, understanding how all of these items will flow through to that. Now, income reported should include all amounts provided as compensation. First, pretty clear, the $80,000 base salary, definitely. Also, the $20,000 bonus. Those two are pretty clear in terms of how they're going to be reported. So the bonus of publicly traded stock, it's taken at its fair market value. And then I think what I would say is maybe the more complicated one here. The non-qualifying stock option will result in compensation equal to the difference between the fair market value of the stock and the exercise price, or $10,000. And we've got our calculation here, how we get there. Final answer is $110,000. Here are some key features of our ESPPs. Just, again, not the most important item here. I'd say answering questions. If you see questions that we have that test this, then for sure, but not really historically the most important. If it does become more important, you'll see more questions on it and you'll be able to take care of them. Now, the key features here must be written and approved by the shareholders. Again, this is a qualified incentive-based one. An ESPP cannot grant options to any employee who has 5% or more combined voting power. Generally, the plan must include all full-time employees, excluding highly compensated employees and those with less than 2 years of employment. The option exercise price must be no less than the lesser of 80% of the fair market value of the stock when granted or exercised. Again, these are all just controls to make sure no one's taking advantage of the system. The option cannot be exercised more than 27 months after the grant date. No employee can acquire the right to purchase more than $25,000 of stock per year. To receive preferential tax treatment, the stock must be held for at least 2 years after the grant date and at least 1 year after the exercise date. And then lastly, the employee must remain an employee of the corporation from the date the option is granted until 3 months before the option is exercised. All right, talking about employee taxation versus employer taxation. Now, generally, no taxation of the option as compensation when granted or exercised. We're beating these points to death. I want to make sure there is no discrepancy in your mind. You understand how this all works. The basis of the stock is the exercise plus any amount paid for the option, if any fees or anything, any premiums paid. Any gain or loss on a subsequent sale of the stock is treated as capital, provided the holding period requirements are met. If they are not met, any gain is treated as ordinary income, as we have seen throughout our examples, up to the amount by which the stock's fair market value exceeds the exercise price. Now, if the options lapse, there's generally no deduction available, as the option was not initially taxed. However, a loss may be recognized if an amount was paid for the option itself, if you have to pay, say, $1,000 in order to get into the program. If the option exercise price is less than the fair market value of the stock on the grant date, then ordinary income is recognized when the stock is sold. The ordinary income recognized will be the lesser of the difference between the fair market value of the stock when sold and the exercise price, or the difference between the exercise price and the fair market value of the stock on the grant date. Nice and simple here for the employer. Generally, an employer does not receive a tax deduction for an ESPP because it's not considered compensation income to the employee. All right, let's see an example here on stock option loss classification. On January 10th, year 1, a taxpayer purchased an option to buy 1,000 shares of ABC Co. for $150 per share. The taxpayer purchased the option for $30,000, which was to remain in effect for 8 months. However, unfortunately, the market declined and the taxpayer let the option lapse on September 10th, year 1. The taxpayer would report which of the following as a capital loss on the year 1 income tax return, and that is going to be a $30,000 short-term loss. And I think overall, none of that is too tricky, but we've got the explanation here. We've got Short term, it's a loss. We can deduct that. Now, an option held by an investor, it's a capital asset, so there'll be a short-term capital loss. Capital asset, which is sold or exchanged within 1 year of acquisition, that's going to result in short term. The cost or other basis of the worthless stock or securities is treated as a capital loss, as if they were sold on the last day of the taxable year, in which they become totally worthless. The option's exercise price is irrelevant with respect to determining loss on account of the lapse of the options. Now, here specifically in this question, the options, which we have seen are capital assets, purchased for $30,000. They became worthless on the lapse date, so that's less than a year. Thus, this is treated as having occurred on December 31, year one, the last day of the taxable year in which the options became totally worthless. Now, because as of this date, it's less than a year, we've got a short-term capital loss, $30,000. Great example. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.